Same house, same tenant, same rent, and $8,500 a year more expensive to own. Not a rate rise. Year 1, this property costs its owner $11,560. Year 2, $20,152. The difference is the refund at the center of negative gearing. Switched off for newly bought established homes. That's the tax reform, and every property versus ETF comparison you've watched was filmed before it. So, the rematch. $165,000, 10 years, 2 doors. And the result I didn't see coming, the reform has split property into 2 different assets, $68,500 apart on identical money. Quick one first, general information, not financial advice. I'm not licensed, and property is the most assumption-heavy thing you can model. Every input is on screen. Argue with them. So let's say a couple in their early 30s. Between them, they've saved $165,750, a 20% deposit on a $650,000 house, plus stamp duty and the rest of the buying costs. The property's held by the higher earner, so we're working at a 39% marginal rate, including Medicare. 2 doors. Door 1, buy the property. Door 2, the identical money into ETFs. And one rule makes this a fair fight, because most comparisons cheat on it. A property doesn't just take your deposit, it takes a top-up every single year. So every dollar the property demands, the ETF side gets that same year. Same money in, both doors all the way through. The loan is interest only on purpose. Paying down principal is saving, not a cost. That's a different video linked below. Year 1, the actual bill. Rent, $25,000, after allowing a fortnight vacant. Against that, interest, $33,800. Agent, rates, water, landlord insurance, maintenance, land tax. $45,500 of costs against $25,000 of rent. A $20,550 hole before tax. Now, negative gearing. The deal that hole was priced on. The loss comes off your salary, and the tax office refunds your marginal rate. Buy today, and year 1 still works exactly like that. $8,990 back. Out of pocket, $11,560. Then the 1st of July 2027 arrives. For an established home bought after May 2026, the salary refund is gone. Careful with the word though. The loss is not lost, it's quarantined, banked and repaid out of future rental profits, or against the capital gain when you finally sell. But you'll get it back when you sell, doesn't pay this year's bill. Same house, same tenant, $20,152. That's the hook number, the entire reform, landing on one property. 10 years on. The property's worth $1.11 million, 5.5% growth a year, which is the 30-year national average, not the number the ads use. Sell it, pay the agent, clear the loan, and pay the capital gains tax, which the reform also rewrote. Growth up to mid-2027 keeps the old 50% discount. Growth after that is taxed on the inflation-adjusted gain instead. Whole video on that one, linked below. And here, quarantining keeps its promise. The banked losses come back and knock the tax bill down to about $18,000. Net position, $544,265. The ETFs, same starting money, same annual top-ups, dividends taxed along the way, capital gains, tax paid at the end. $570,000. 113. ETFs by $25,847. On the old rules, that comparison went the other way. The reform didn't ban anything. It just removed the annual subsidy that was quietly closing the gap, and the gap stopped closing. But that's the average property, and the reform has just made averages misleading. Here's the part I didn't see coming. Now run the identical money into a new build instead. Same price, same deposit, same growth rate, same tenant. $612,777. That's $68,500 ahead of the established property on exactly the same capital, and nearly $43,000 ahead of the ETFs. 3 doors open for a new build, and only for a new build. 1. Negative gearing survives. The annual refund keeps coming. 2. Depreciation, under a rule that predates this reform. Since 2017, a second-hand home earns a fraction of the write-offs, while a brand new one deducts the building and everything inside it, front-loaded. And 3. At sale, you choose the old 50% discount, or the new indexed method, whichever is cheaper. So the honest headline isn't property versus shares anymore. The reform has split the property market into 2 assets with genuinely different after-tax maths, and most of the internet is still discussing the average of them. Before anyone runs off and buys one, the test that matters, and this is the part I'd want someone to show me. That entire advantage is a tax advantage. It assumes the new build grows at the same rate as the established place. In practice, you very often pay a premium for new, and a bigger share of your price is the building, rather than the land. And it's land that compounds. So, haircut the new build's growth. 0.5 percentage point slower, that's all, and its lead over the ETFs collapses to $2,500. On $600,000 over 10 years, that's noise. A full percentage point slower, and it loses by nearly $28,000. The whole tax advantage of a new build is worth roughly 0.5 percentage point of annual growth. That's the entire prize, which means the question was never new or established. It's whether the specific new build you're being shown will grow within 0.5 point of the alternative. And the people most eager to run these tax numbers for you are the people selling house and land packages on exactly this pitch. Numbers this size are worth being suspicious about, including mine. 2 dials, because your answer isn't my answer. Growth. At 4%, the established property loses to the ETFs by 152,000. At 7, it wins by 76. Everything else in this video is rounding error next to the growth rate you assume. And nobody knows it in advance, including the person quoting you 500% since 1990. Bracket. Interestingly, the higher your income, the better property looks here. Not because negative gearing came back, but because the ETF side pays tax on its dividends every single year at your marginal rate, while the property's gain sits untaxed until you sell. At 47%, the 2 doors are almost level. And stretched to 20 years, the established property falls further behind, 154,000, because you're funding that hole out of after-tax salary for twice as long. The caveats properly. This is one property against a diversified index. I've given property the benefit of leverage without pricing the risk that comes with it, and a single dwelling can underperform its own city badly for a decade. Land tax and stamp duty are state-specific. Dial them. The new build depreciation here comes from typical schedules, not a surveyor's report on a specific property. And if that number is softer, so is the advantage. And none of this touches the home you actually live in. Different question, different maths, mostly not a financial decision at all. So, the next dollar call. On the law as passed and the assumptions on screen. For an established investment property bought today, the next dollar has a harder job than it did 2 years ago. The annual refund that used to carry the early years is gone from July 2027, and over 10 years, this one lands behind a plain index fund. For a new build, the tax code is genuinely more generous, and that generosity is worth about half a percentage point of growth a year. No more. Anyone selling you one on the tax benefits is selling you that half a point. None of which tells you what to do, because the input that decides this comparison isn't in the Tax Act, it's the growth rate. Pick the one you'd defend out loud, put it in the model, and see which door your own number opens. Every assumption in this one is on screen, so argue with the inputs, not the vibes. And tell me in the comments what growth rate you'd actually defend, because that's the number this whole thing turns on. If you want more Australian money questions run properly through the numbers, subscribing is the one-click way to keep them coming. See you in the next one. Cha-cha.